Let's explore how the rising interest rates are affecting property investors, tenants, as well as potential buyers, emphasising the crucial insights for safeguarding property investments after what has been a big week. For more, we're joined by Gianni Musumeci from Leverage Property Advice. It's great to have you on the program once again, Gianni. Talk to us about the increases in the RBA's cash rate that we have seen this week and what you believe the impact could be for property investors.
Yeah, look, thanks for having me. Look, in terms of the impact that interest rates will have on property investors, borrowing power might be pared back ever so slightly after one interest rate rise. However, I don't feel that investors will be too deterred by a single rate rise as such. Overall, we may see that investors might be in a little bit more of a hurry to purchase while they have approval at the current rate or out of fear of subsequent rate rises should inflation remain on the rise. But at this stage, not too big of an issue.
Yes, it's interesting you say that because obviously we have witnessed 13 rate rises since the end of the lockdowns, and that would no doubt be putting a lot of fear into people that what we're seeing now with the rise of inflation had dropped, it's bounced back up again, that we could be witnessing another continuation of consistent rate rises. What are your views on that?
Look, I feel that should inflation not get under control, that we will see interest rate rises. I'm noticing that some of the fixed rates, the longer term fixed rates, and even the term deposit rates that banks are advertising are higher in the longer term. But in the shorter term, we're still seeing that those interest rates are relatively lower. So that being said, those future indicators might indicate that those interest rates might rise in the future and that banks have priced that rate rise in, but for the short term, not as much.
Given that that rate cut last year came as a little bit of a surprise, it was very controversial just before the election. Many analysts saying this should not happen, it will just lead to increased inflation, and that has happened. Do you think that many people, I guess, reading the market commentary as well as the commentators and the banks had already priced in a potential rate rise, and so therefore it won't be as scary for investors?
Well, look, a lot of economists are looking at the uncertainty that's happening in the world, and essentially the RBA themselves are really only relying on that lagging indicator performance. They're looking at data like unemployment rate, they're looking at consumer spending, inflation data as a main headline, but overall they can only make their decision based on what has happened, not what will happen, and therefore they have to make those decisions on a regular basis based on what's happening in the moment.
Yeah, we always think about those first-time investors who are always uncertain and not sure when to jump in. How do you think they should evaluate the current market conditions?
Well, look, in terms of the impact on the overall property market, a single rate rise again won't do too much to deter investors and first-time buyers, especially under the low deposit scheme, because there's still a relative low amount of stock on the market. There's still going to be fierce competition because we've seen that loan commitment rates have gone up. And I feel, if anything, there's going to be more of an impact to tenants because they're in a tough position with low vacancy rates in a lot of areas across the country. And the rate rise will no doubt be passed on to them as there's a relative lack of choice. Their choices are to either deal with the rent rise or to look for properties themselves and to contribute to that overall competition. The other impact is as well that a lot of states have limits on the amount of times that you can raise rent. So we're not going to see much impact immediately, but I feel that this rate rise has also added that pressure on rental growth as well.
What common pitfalls do new property investors often face when they're jumping in?
Look, I feel that a lot of property investors, they look at headline rates like gross rental yield and they don't really understand the underlying cash flow of the property. You need to actually look at the actual cash flow of the property and not just that headline gross rental yield rate, because it's often misleading. It doesn't necessarily mean high cash flow. High gross rental yield doesn't necessarily mean high cash flow. It can often mean high expenses. So over the last couple of years, I've seen a few amateur investors especially purchasing property. And then as a result of, like you said, those 13 interest rate rises, they've actually had to let go of their property because of not only interest rate rises, but increased expenses through inflation. And they've been forced to sell the property as they've been unable to keep up with expenses. So this is one of the biggest issues that I'm finding that amateur property investors are making is they need to understand that they need to have a look at the actual cash flow of the property, but also their own personal cash flow as well.
Yeah, very much so. I know that there are a lot of strategies that people can be using to, I guess, help mitigate the risks associated with interest rate rises. Where can we send people to get in touch with you to find out the answer to that?
Yeah, look, I'm on all the social media channels at Leverage Property Advisors, and then my website, leveragepropertyadvisors.com.au.
All right, really appreciate your insights here on Ticker once again. Gianni Musumeci, thanks so much for joining us on the program.
Pleasure. Thank you so much.